Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon Free Market Show. Before we get started, please take a look at the screen being shared, the disclaimer. Be aware Market Chameleon is not a registered advisor, either Dimitri or myself. So please take everything you hear as informational purposes only. If you need to consult an investment advisor, please do. With that, welcome, Dimitri. How you doing?
Good. Thanks. So let me share my screen here. Um, and as a note, anybody join us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data or the analytics. And if you have a question, type it into the live chat on YouTube. Will's keeping an eye on it and he'll read them back to me. And to give you a couple minutes to put those questions in, we're going to start out looking at the pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we will move on to the questions. So pre-market report, here up top, you do see this calendar view displayed for the last week. And this shows a summary stat of what happened in the pre-market on that particular date. And that's just for being able to eyeball potential trends or something unusual. If you want to go back further, you could drop this calendar down and pick a date that goes out further. But today we are on March 5th. And so far we see 401 stocks trading higher than pre-market and 557 stocks are trading lower. We have 227 million shares trading on up volume versus 112 million on down volume. And if we convert that volume to dollar value, we have $2.8 billion worth of stock trading lower versus $4.1 billion worth of stock trading. I'm sorry, $2.8 billion worth of stock trading higher versus $4.1 billion worth of stock trading lower. And just from that summary, it appears that there is a bearish bias in the pre-market trading. Let's take a look at it from a couple more perspectives, then we'll move on to the questions, and we will come down a little bit further on this page. And now we see a list of stock symbols that are trading in the pre-market hours. There's a list of our most active stocks, biggest percentage gainers, and then biggest percentage decliners. We have 68 stocks that made it onto our biggest percentage gainers list, 124 stocks on our biggest percentage decliners. So that also points to a bearish bias in the pre-market trading from this perspective. And a couple things here about this list. We set certain thresholds for price, liquidity, volume, because of the way stocks trade in pre-market hours, sometimes with very low volume or liquidity. And if it meets that threshold, if the stock trading meets that threshold and it's trading in pre-market hours, it can make it onto this list. And that does include small cap stocks, ETFs, leverage products, could be an inverse ETF. And to narrow down this list a little bit further, we could use the filters above. If you have a watch list and you create a watch list of stocks that you like to track, you can filter this list by your watch list. We're going to use this filter, for example, an ETF. And when I click on it, you get different ETFs to select from. I'm going to choose SPY, which is the S&P 500 ETF. And after selecting that filter, we see that the list below got filtered by stocks that are holdings in the SPY, right? Which are the S&P 500 constituents. We've got 6 stocks that made our percentage gainers list, 13 on our percentage decliners list. So you can see the symbols in here. And that also points to a bearish lean and pre-market trading. So far we looked at it from a couple different perspectives, and they all indicate that trading in a pre-market hours is, has trading with bearish sentiment. I gave it a couple minutes, Will, so at this point I'll stop and take questions.
Nothing's popped up yet, D. We did have a question I was going to email to on an email, and they asked how far out does the events go? I guess when we're pulling the event information, how long out does that go?
So I believe we're looking at the company events over here.
Yes, correct. Sorry about that.
Yeah, so the company events are compiled. We compile them internally. We have a team of people parsing press releases, visiting investor relations websites, and so forth. And if there is an announcement of an event that's a week away, 2 weeks away, 3 weeks away, as long as we could find something to reference, we'll include it in our events calendar, right? So if let's come out to April. Let's see. So you hear even in April, right? This is a month out. We have some events here, and not as many as we have in March, because sometimes they don't announce it that far away. But as long as we can reference an official announced event somewhere by the company, and we pick it up, we add it to our database. And if it's a week away, it'll be in, or it could be a month away, as we're seeing here, if it's 2 months away. So we don't control how far it goes out. It's based on when the company announces, if we pick it up, and how far into the future they announce their schedule of events. Right. So somewhere it has to exist. So as long as there's a future, we don't stop it. If the company gives us a schedule of events for the next year, we'll add it for the next year. We won't cut it off. But there has to be some schedule of events announced by the company that we could reference.
Great. Now, the great thing about these events is we match them with our other calendars and stuff too, which they sit, and you can see them on the option chain, can't you? If an event occurs in a month, then
yeah, like here's one in Walmart, right? So in Walmart, we see that there's going to be that they announced on April 3rd they're going to be attending this JP Morgan annual retail roundup, right? You could see here there's going to be Omar Tor, executive vice president, will be speaking, CFO. So this is going to be April 3rd. We're March 5th. This is a month away, but let's take a look what it would look like on the options chain, because if you're trading options, that's the important part. What are the potential catalyst events, right, that exist? So I'm going to go here to the options chain. And now what do we see here? This is the options chain with the different expirations, right? So you could see here on Walmart, you have expirations going out all the way till January 16th, 2026, right? And near the expirations, we have these little indicators that are important or potentially important for options prices. So what are some of the indicators that are important for options prices? Let's go over that. Well, like the company event that we just talked about. So you see this little C, that's a company event. If you hover over it, now you see there's March 5th and March 7th, two different events that will come for March 8th, right? So March 8th, those options expire after these two events, right? So you're going to have Raymond James Institutional Investor Conference. You're going to have Morgan Stanley Technology, Media, and Telecommunication. So you have two potential events there we don't know what's going to happen. Maybe nothing, they're not exactly like earnings, but if you have the company going to these events and presenting, there's a potential that they do provide some kind of forward-looking statement or state of the business, or revealing a new technology or new product, or something can always potentially happen, right? Because you're at an event, there are other people there, there's potentially investors there.
Yeah, and companies have to announce their information to everyone, right? And they use these events
as a
if
public.
there is
Yeah.
something they want to announce, because
Yeah, exactly. Then you're kind of announcing it to the public, right? Because you've
you're
already.
definitely announcing it to the public.
Yeah. So so now I'm hovering over it, and then we see that those two events will cover March 8th, and obviously all these other ones will cover this, right? Because all these expire after March 8th. So now look at March 15th. We have two indicators, right? I'm hovering over it. One is the dividend, March 14th. So we're expecting to go to X dividend March 14th. That means the March 15th option will expire after that. Well, that's important because option prices include, there's a dividend component to the cost of carry. So you got to make sure that you have it in there, and that you have the correct amount. Do we have an announced dividend amount, or do we have to forecast it? But that's going to be important to option prices, right? Their entire strategies just doing that alone. So now we got the dividend that's going to be covered there. That's important. And then potentially exercise your options, right? If you have deep in the money calls and they become an early exercise, you got to remember to do that, or you're going to leave, cash on the table, money on the table. It's just you're just gonna give it away if you don't look at that and efficiently, exercise your options. And what else do we see? Well, now we got two more events, two different events, right? So now we have four events that are going to happen before March 15th. We have two events over here, March 8th. So I'm hovering over March 5th and March 7th. There are two events, right? And obviously March 15th expiration is going to cover that, because March 15th comes after these two. And then when I hover over here, well, hold on. Now we got an event March 12th and March 13th. We got Bank of America Consumer and Retail Conference. And then we got UBS Global Consumer and Retail Conference. Now, we don't know what's going to happen on those events, right? We just have a potential catalyst event on our schedule, right? It's a potential catalyst event. It's not going to be maybe like earnings, where we know that the earnings usually create more volatility and a big repricing based on what happens. So these don't always, create a stock movement, because sometimes there's nothing like significant or material revealed, not every time. But it's important to know ahead of time that these are coming up, because there's a certain percentage, certain probability that it might happen, right? That they might say something, that this is a chance that they could reveal something material. So that's why we put them. So now we got these indicators here. What else? As we go down the line, we have more company events here. Company events. Then we got an E here. Well, that's earnings, right? So why is there a star next to that E? Well, we're trying to project when the next earnings announcement will be, because unless the company just comes out and flat out tells us this is the date, right? Like, we're going to announce earnings. So if we get a press release, or they put it on their investor relations website, or somewhere where there's an official company source that we could reference until that happens, until they tell us like this is the date we're going to announce. Well, then we're not exactly sure. But here's the problem. We might not be sure when they're going to announce, but we know they're going to announce another earnings, eventually, and it's usually once a quarter, right? We know that's going to happen, and that's going to impact option prices because you don't want to sell options that cover earnings at a lower implied volatility, because eventually once they announce it, that there's going to be an event that you're going to misprice them, right? You're going to misprice options if you're selling options at an implied volatility at the same level when there's a non-earnings, right? That doesn't make any sense. So what happens is, I'm like, okay, we don't know right now when the next earning is, but we know that we don't want to, potentially sell these, misprice these options. So we have to try to estimate when we think the next earnings will be and see which expirations cover it. Okay, so that's what that E with the star means. The star is telling us we're putting in an estimated earnings, and you can see here we're estimating between May 15th and May 17th, which will cover the May 17th expiration. Right now, that's our estimate that we're running an algorithm, based on the historical schedule. That's the Market Chameleon estimate. And are we close to the street's estimate? Right? Is that agree with the street's estimate? Well, we could see here something that can clue us in here. We see that the month before, April 19th, we have a 14.5 implied volatility. May 17th, the implied volatility jumps to 17.3, and you can see that the next month it kind of drops. So the month with the earnings, the expiration month with the earnings, you should see a jump from there in the non-earnings month, and you'll usually see that month a little bit higher than the next month, right? That's how usually the earnings expiration looks like. That's how it would look like, right? So our estimate seems to be agreeing with the street's estimate or the implied volatility estimates, how everybody else is pricing the options, that the next earnings announcement looks like it's gonna be after April 19th expiration, but it's gonna be somewhere that before May 17th and cover that expiration. All right, so that's kind of like what these are indicators are helping you along the way. All right, these are helping you along the way because all these indicators here, why do we put them on there? It's not because we don't want to just fill up space if it's not material enough. But these are important because they could impact the option premiums, the option prices, and the stock movements, right, as well. It's potentially stock volatility and stock movements. So we, for convenience, put them there alone. And just to give you guys an idea, like just to collect all these, all these events, I'm sure some of you could appreciate it, some of you might not know, but just collecting and having a team of people going out there and parsing these events and doing and then subscribing to third party feeds to cross reference and all that, just that alone, without any of this, just that alone, you're talking about tens of thousands of dollars a month, so just to compile that. But those are important, right? Those you can't do if that information exists out there. right? If that information somewhere exists out there and we could find it, then we put it into our database, because those are material to option prices, options, implied volatility, and potential stock moves.
Great. That was awesome, D. Thank you.
Yep. Yeah, and thank you for the question. So as you could
Yeah,
see
he
here,
did. The question, and it was an email this morning, and we haven't talked about it so long. So I thought with no questions, it was a good one. What
okay.
subscription package do you need to, like, what's free and what's premium with those events? It's been so long, I'm not exactly sure.
Yes, I mean, I'd have to. I don't recall offhand,
I got you.
anymore.
Well,
Yeah,
anyways, there
I'd
is
have
a,
to-
I mean, all you have to do is go to the subscription section. Everything's listed there. So,
right, right, exactly. And again, that's if whatever this to do this on your, I know that this is it's a you know it's something that takes hours and hours and hours every day to compile, right? You're talking about, I think we have a team of people that are doing it, for something like 8 or 9 hours a day, looking, scanning, parsing, and entering this in, including Saturn. So it's
yeah, and then we're
it's
running
a
it against our
long,
data, which is important too. I mean, I think
yeah,
that's
it's a
the most important
long,
thing.
yeah, it's a long, long process to, just to get this, because you could, you know, to get these events, um, all organized and put in a database. And again, some of these, as you could see here, we're estimating the event because we know it's going to be important, and that event, based on history, we know it's repetitive. Earnings are repetitive, right? They are announced once a quarter, so we know it's going to come up even if it's not announced. Like something like this, these company events, that you can't really forecast because they're not regular, right? So you have to wait for the company to actually announce that they're going to be attending, these conferences, and then they give you more information. So those are things that we really cannot, anticipate until the company actually announces it. Now, the dividend is also something that, if they don't announce the dividend date, right? But we know from history that there is some kind of a consistent dividend, regular dividend, and we could use that historical data to forecast a potential future dates and amounts. So we will put in a forecast because that's important. You can't, if you're pricing options, you need to know the X date and the amount. And if you don't know, you have to try to estimate, or you're going to misprice those options, right? So let's go over here, for example, for the dividends. I'm just going to go for Walmart dividends. So here, Walmart, this is what we have. Walmart announced, so you see this? So March 14th, May 9th. So they actually announced their dividend schedule for this year. So they did announce it. And so we put in those dates. Okay, so one thing I am looking at, I believe this year, because I'm looking at these. One thing to look out, I think that at some point this year, we might, the settlement might change towards same day settlement. Okay, so right now, the record date, next date, you'll see they're a day apart. So I'm going to have to check this. Hasn't happened yet, but I believe that we are looking at some point this year that the settlement, the SEC's, it's going through the SEC process, rule book and stuff like that, that settlement is going to change, and that's going to impact these. So we'd have to go in there and then change those as well, meaning that the X date, instead of being one business day before the record date, it will be on record date. Okay, so instead of, like, say, May 9th, it'll be May 10th. So this one, instead of August 15th, it'll be August 16th, because you're going to have, I believe, for dividend purposes, same day settlement. Okay, so so that's something to keep an eye out for. You guys could look it up, but we're keeping track of it, obviously. But that's something to keep in mind. If that does change, and we go to 1-day settlement, then these will change as well. And we're almost out of time, but these are very important. If you're trading options and you're looking either for potential mispricing implied volatility, or mispricing in the cost of carry, such as dividend interest, or when we talk about mispricing implied volatility, it could be something that is not considering a potential catalyst event. That could also be mispricing. So if you guys ever see the movie The Big Short? So The Big Short, it was with Michael Burry, right? When he went and started shorting the credit defaults, buying credit default swaps to short the mortgage industry. Well, there was besides Michael Burry, there was another, like, young team doing it. They caught on to it and they started doing it as well. They're like, I remember 2 young guys right out of college.
And there were a lot of people who were buying these credit default swaps, but just buying them against positions. These guys were actually taking a position, right?
They were taking a position that the credit default swaps would, that they were mispriced, that they were grossly mispriced, that that they were not considering, right? That some of these mortgages are going to start defaulting.
Yeah, banks were only created them so the mortgage business could exist, right? Like there was some sort of hedge in the market. They weren't pricing it like people were going to bet on the risk.
Right. So people started betting on them instead of just using them as protection against positions. People were just outright betting that the things would fall without a position, that they would fall.
Yeah, like we were talking about skew the other day, and they were, it was like probably a flat, maybe even maybe there was, it was actually very light vol put into it, because they were just banks were just setting it up so they could trade with each other, so they could have a hedged position, not identifying it as a risky position.
Right. So, but the point why I brought it up was prior to the credit default swap, what they were doing, these 2 guys they were looking for mispriced options. In other words, they were looking for these events. They were compiling the events and saying, well, wait a minute, these options, right, the implied volatilities are too low, because they're not considering the probability that, one of these events would hit. So they made millions of dollars before that credit default swap. That's what they were doing. FDA announcement, whatever, they were saying that the options are just not considering these events. They're mispriced. People aren't considering them. So they would, obviously you're not going to win every time, but when they hit, they really hit. So they were looking at these as mispriced events. And one of the things with the credit default swaps were that they researched, well, when, so these credit defaults, or whatever, in short, for 3 years, 4 years, 5 years, but they researched, well, within the tranches, right? When do they reset? When do these interest rates, the variable rates reset where it had the highest potential to default, right? So if somebody took out a loan, 3% variable rate, it's locked in for, like, say, the first year. Well, in the year, it could reset to 5% or 10%, whatever it is. So they did this research and said, well, these are the events where these loans are going to be reset. And that's a potential catalyst, because if they reset and people can't afford them, that triggers non-payment. And after 6 months, non-payment, then it triggers a default. So whatever it is, they created this. That's what they're experts in, right? They were experts in event trading. And that's how, and I don't know, I think that they ended up making like $1 billion on it or something like that. I forget, but a lot of them made a huge amount on those credit default swaps. So I guess we're right up at 9:30. Will, I'm going to let everybody go.
Great job, D. Chameleons, do your research. That's why it's there. Great job, my friend.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, Chameleons. Everyone have